Hi everyone, welcome to the channel. Today we're diving deep into the recent roller coaster ride of China's stock market. Why do ordinary investors repeatedly fall into the same traps? What drives these massive market swings? And most importantly, how can we navigate these turbulent waters? Let's break it down together. China's stock market is more than just a financial platform. It reflects the interplay between economic policies, societal trends, and individual behavior. With recent volatility shaking up the market, it's essential to understand the deeper forces at play. Section 1. The mechanism of China's Sawtooth harvest. 1.1. What is the Sawtooth harvest? The term Sawtooth harvest refers to a deliberate market manipulation strategy where stock prices experience sharp, cyclical rises and falls. These cycles lure retail investors with the promise of gains, only for them to face significant losses when the market inevitably dips. Market data. Over the past 2 years, the A-share market has seen repeated cycles of sharp rises followed by steep declines. For example, in October 2024, the market peaked at 3,674 points before plummeting to 3,168 within just 3 months, wiping out over 20 trillion yuan in market value. What's driving this? The main drivers are policy interventions and institutional manipulation. The government uses monetary policy to inject confidence into the market, while institutional investors exploit volatility for their own benefit. 1.2. The paradox of a policy-driven market. China's stock market is often called a policy-driven market, where government actions significantly influence investor behavior. However, this creates a paradox. While short-term policies may boost the market temporarily, they often undermine its long-term stability. Overuse of policy tools. For example, in 2024, the government implemented stimulus measures to increase liquidity and encourage market participation. While these policies initially boosted the market, they eventually led to speculative bubbles and widespread losses among retail investors. Institutions versus retail investors. Institutional investors, with their access to better resources and insider knowledge, profit from these cycles, while retail investors are left holding the bag. Section 2. The psychology of retail investors. 2.1. Who are the retail investors? Retail investors make up over 70% of participants in China's stock market. Their behavior has a profound impact on market dynamics, and their profile reveals key insights. Education and awareness. Many retail investors have limited financial knowledge. Over 50% of them hold only a high school diploma or associate degree. This makes them heavily reliant on advice from social media, friends, or self-proclaimed market experts. Demographics. Middle-aged and older investors, 40+, dominate the market. Many of them invest to grow their savings or secure their retirement, often without a clear investment strategy. 2.2. Key psychological traits. Retail investors in China share several defining psychological characteristics. Blind trust in government. Many believe the government will always step in to stabilize the market, which leads to overconfidence in their investments. Speculative and herd mentality. Instead of focusing on long-term growth, most retail investors aim for quick returns, often following market trends without independent analysis. Section 3. The financial ecosystem of exploitation. 3.1. How a manufactured bull market works. China's stock market booms are often artificially created through government interventions. These cycles are part of a complex financial ecosystem designed to redistribute wealth. Draining household savings. With over 140 trillion yuan in household savings, much of this capital is funneled into the stock market, becoming a key source of profit for institutional investors. Institutional profits. Whether the market rises or falls, institutions use high-frequency trading and derivatives to secure consistent profits, while retail investors are left to absorb the losses. 3.2. Risk transfer and policy battles. During periods of market volatility, risks are systematically transferred from institutions to retail investors. Institutions offload their holdings at market peaks, leaving retail investors to bear the brunt of the downturns. From markets to society. As retail investors suffer significant losses, consumer confidence declines, leading to broader economic instability that requires further government intervention. Section 4. Why do retail investors keep falling for it? Despite repeated losses, retail investors continue to flood into the stock market. Why is that? 4.1 Limited investment options. With real estate stagnating and foreign investments tightly controlled, retail investors have few alternatives. For many, the stock market feels like the only viable option for growing their wealth. 4.2 The sunk cost fallacy. Many investors, after experiencing losses, refuse to exit the market. Instead, they double down, hoping to recover their losses. This emotional attachment often exacerbates their financial difficulties. Section 5 Future trends and how to navigate them. 5.1 Expect more sawtooth cycles. The sawtooth-like fluctuations in China's stock market are unlikely to end soon. As long as government policies rely on short-term stimulus measures, retail investors will remain vulnerable to these cycles. 5.2 Rebuilding trust in the market. To restore confidence, the government must focus on transparency, stricter regulations, and protecting retail investors. However, whether these efforts can truly rebuild trust remains to be seen. Conclusion: finding a way out for retail investors. China's stock market issues go beyond economics. They're a reflection of deeper societal and systemic challenges. For retail investors, the key is to improve financial literacy, avoid herd behavior, and develop a long-term investment mindset. If you found this analysis helpful, don't forget to like this video, subscribe to the channel, and share your thoughts in the comments below. Let's work together to navigate these market challenges and make smarter financial decisions. Thanks for watching, and see you next time.